Predict the future with Fibonacci and EMAs. This video is for educational purposes only and should not be considered financial advice. The 200 exponential moving average, the 50 exponential moving average, and the 4 exponential moving average with the Fibonacci sequence can help you predict price moves before they happen. In this video, we will go over an easy way to tell when price will move and where it will move to. As many trading theorists say, accurate trading is about time and price. If we can accurately predict those two things, we can have an edge in the market. The moving average tells us roughly how many bars until price will return back to it. Fibonacci tells us the different levels price will react from. By combining these tools, we can predict the future and know what area price will react from and when it will do it. Key pointers. The 50 EMA. Price will start to retrace back to the 50 EMA between 20 to 25 candles. The 4 EMA with a shift of 4. Price will start to retrace back to the 4 EMA between 7 to 9 candles. Shifting the 4 EMA by 4 makes it similar to a 16 EMA. The 200 EMA. Price will start to retrace back to the 200 EMA between 90 to 100 candles. Setting up your chart. Plot the following on your chart: the 200 EMA, the 50 EMA, and the 4 EMA with a shift of 4. Draw a Fibonacci extension from the most recent swing high or low. Use the following Fibonacci level extensions: 1.27, 1.618, the 2, the 2.3812, 2.618, and the 3 level. For your entry on buy trades, use our MACD RSI entry technique. When price breaks structure on a green histogram, wait for a red histogram and price to go below the 50 EMA. Once price crosses above the 50 EMA and the 4 EMA, enter when price closes above the 4 EMA. Put your stop loss behind the previous candle's low. There's a higher probability of this trade working out when price is above the 200 EMA. For your sell trades, again, use our MACD RSI entry technique. When price breaks structure on a red histogram, wait for a green histogram and price to go above the 50 EMA. Once price crosses below the 50 EMA and the 4 EMA, enter when price closes below the 4 EMA. Put your stop loss above the previous candle's high. There's a higher probability of the trade working out if you're below the 200 EMA. Your exit is when you reach 1.5 times your risk, or when liquidity is taken, or you've reached the 20th to the 25th candle, or when price closes below the 4 EMA with a shift of 4. You can decide which one is going to be your exit. For sell trades, again, when you reach 1.5 times your risk, when liquidity is taken, between the 20th or the 25th candle, or when price closes above the 4 EMA shift of 4. Risk management. Always make sure you are exercising proper risk management. Only risk 1% of your account per trade. Your stop loss should ideally be above or below the closest swing high or low. However, in this example, we are going above the previous candle or below the previous candle. Your take profit should be at least 1.5 times your risk. Your trailing stop can be the 4 EMA shift of 4. In this example, We have drawn our swing low and our swing high. Price breaks structure and then turns green. There is a red histogram on the break of structure. There's also a trend line break. Once price went up above the 50 EMA and there's a green histogram, price closed below the 4 EMA and close below the 50 EMA here. This is your entry. You can exit right here. There is a stop loss behind the previous candle's high, or you can use the previous swing high. The exit is between the 20th and the 25th bar, as you see here. Also, liquidity is taken. The other examples in this same trading session are a break of structure while we were in the previous trade, and you can draw your swing low and swing high Fibonacci extension. You wait for price to go above the 4 EMA, and it also reaches the 50 EMA. And the histogram turns green. This is also a displacement over here with a trend line break. Once price crosses the 4 EMA, and it had already crossed the 50 EMA, that's your entry. And your exit is on the 18th bar here. But you've already reached 1.5 times your risk. You can also take another entry because this is a break of structure. Price retraced back above the 50. There's a green histogram. There's also a trend line break on this break of structure. Then price closes below the 50 EMA and the 4 EMA. That is your entry. And then price continues down, takes liquidity. And this is probably your better trade because the 22nd bar is here. And that's when price reaches the 2.618 level. You could consider exiting when price reaches the 1.618. But again, we're still below the 4-period EMA. And we're actually very far away from it. So that gives you a clue that price is still going to continue to the downside. In this example, we see a large displacement. Then price moves back in for a retracement. And we see a big separation between our EMAs. Price closes below the 50 EMA. It crosses back above the 50 EMA and the 4 EMA. And you could have entered right here because there is a break of structure. Price came back. It went red on the histogram and then crossed above the 4 EMA after touching the 50 EMA. That is a legitimate entry. However, if you wanted more confirmation, there's a break of structure here. Price retraces, crosses the 50 EMA. There's a red histogram. Then price crosses back above the 4 EMA, and that's your entry right here. You get your 1.5 times your risk, and price continues to the upside and doesn't close below the 4 EMA until here. And this is the 20th bar. After crossing the 50 EMA here, you reach the 20th bar here, and that could be your exit. So looking at this chart, in terms of predicting price movement, we count the number of bars from the last time price has crossed the EMAs. So the 50 EMA was crossed here. This is the 20th bar. It crossed the 200 EMA here. And this is the 91st bar since that crossing. Halfway point is the 100th bar. As we see, price continues to move down to try to reach back to the 200 EMA. and it almost reached it on the 118th bar. But then it reversed and continued to the upside. So this is when you can predict price movement. You use the number of candles price has moved, and you use the Fibonacci extensions to tell you where it will move. If price has not reached an important Fibonacci level, like the 1.27, the 1618, the 2, the 2.3812, or the 2.618, then we know that price will most likely continue to reach that if it has not reached its 20th bar. And as we see after this 50 EMA cross, price skyrockets to the upside, and after 1, 2, 3, 4, 5 bars, it hits the 1.618. You might be tempted to exit here, but since price has separated from the 4 EMA so far, we can guess that it will continue to move at least to the 2 level. And then when price reaches the 2 level, we are at 1, 2, 3, 4, 5, 6, 7. This might be a consideration because after 7 bars, price may retrace back to the 4 EMA. However, we see a huge move beyond the 2 level of the Fibonacci, and that gives us a clue that we are continuing higher. When we reach the 2.3812, that's when you see some type of retracement. So you may consider getting out here, which is around the same level that we would have gotten out anyway. In this last example, we see again a large displacement. Price retraces. There is a break of structure here. Also a trend line break. Price crosses the 50 EMA here. And then price retraces after going red. It goes green and then goes red again. When price crosses above the 4-period EMA, that's our entry. And you put your stop loss below the previous candle. Now here's where you have to use your judgment. Since the previous candle is so close to the next swing low, you might want to consider putting it under the swing low, because when price reversed, it took out your stop loss, but it did not take out the previous swing low. And if you're continuing to count your bars correctly, price crossed the 50 EMA here, we retrace back to the 25th bar. That's when price retraced to go take out any stop losses over here. But you still could have stayed in the trade. And once after the 25th bar hits, price crosses that 4-period EMA again, and you could have re-entered. Then price continues to the upside, gives you your 1.5 risk to reward. And if you're counting your bars correctly, after crossing the 4-period EMA, you want to look for a retrace on your 7th bar, which is here. However, price had other designs. It rockets to the upside, and you can continue to stay in the trade because you know it's going higher. So you want to look for the 9th bar, which is around here, and that might be your exit. If you wait for price to go back below the 4 EMA, which happens on the 14th bar, you get a lower exit. So you see how we use EMAs and Fibonacci together to find out where price is going, when it's going there, and how we can take advantage of that. Backtest and forward test. Always backtest your strategy to see what it looks like in different environments. Then forward test your strategy to see what it looks like in a live environment. It is always a good idea to backtest a strategy 100 times and then to forward test a strategy 100 times for best results. Take notes. Always take notes of details during your backtesting and forward testing. These notes will help you recognize market fluctuations and fakeouts. We hope you enjoyed watching our video, and please like and subscribe for more videos like these. If you have a question or comment, please post it in the comment section below. Thanks for watching.